Hey everybody, it's Chris with Life 180, and I'm here today with Galen from Canadian Whiteboard Finance. And we're going to be talking about, is whole life insurance a good investment in Canada? I've done a ton of videos on this topic about the United States. As we've talked about in the past, there are nuanced differences between Canadian policies and United States policies. A lot of different terminologies used, even though they really kind of perform the same functions. So I think it'll be really beneficial, Galen, if we can go through and kind of talk about attributes of an investment. Is whole life a good investment? What does that look like? And kind of talk about all the different moving parts of it all. And so welcome, man. Good to have you again. It's been a couple of weeks.
Absolutely. Yeah, no, thanks for having me. Yeah, no, and I appreciate this topic is definitely a big one. It's one I have right now. Like basically I had someone come to me looking for implementing the concept of whole life in their financial planning, took it back to their accountant. Their accountant compared it to an investment and they're like, oh, like, how does it work? Like, would you be better off doing this or this? And it really made me want to bring this to the table as a conversation between you and I to see what is the proper way of like comparing this. Cause everyone like, it's human nature is to try to like put something in a category that they already understand and then
Yeah.
compare. So I think it's a good place to start and look at for this
Awesome.
product.
Perfect. Love it. So let's get into it then. So what was the major thing in that situation? I mean, they obviously they didn't know they weren't comparing apples to apples, like you said, but how did you handle that? Like, what did you say to the individual?
Yeah, and so good question. Like as always, what I do is definitely happy to talk about product, happy to talk about numbers, but first I take it back to the conceptual idea, like what about this concept is going to work versus another concept. Like that's always what I'm about is like, is this, I always say like anything, I think of people's financial plans as ships.
Yeah.
Ships sailing towards a destination. And so I'm like, is your ship going to sail faster if you do this? Or is it going to slow it down? Like, is it going to be an extra sail on your financial ship, or is it going to be an anchor that actually slows it down? Because I've seen it happen. I've seen people take on different things thinking it was going to be helpful, and it actually slowed them down. And they actually lost years of potential growth or like movement of sailing towards that goal. So that's where I started. So that's where we went to is the conceptual. Like, why do people take this on? Because people do it. People have billions of dollars. People have put over the history of this product billions of dollars into it, right? So the question is like, who does it and why? So that's really the conversation. We took it back to that. So like, what are the top reasons people implement this?
Love it. Well, so, I mean, I'll jump in here real quick because it's just on top of my mind. I'm a big believer, like one of the biggest challenges that we have in the world is especially when it comes to the personal finance element of the economy. And there's a huge lack of education about personal finance, first of all, both in Canada and the US, I think. And we're told this myth, and I this is a hill I'm willing to die on, that we need to people think they're saving for their future when they're saving for retirement, right? And we've all been taught like we need to save for retirement, right? That's a phrase you hear is like, I need to save for retirement, right? But the problem is people aren't saving for retirement, they're investing for retirement. And there's a difference between investing and saving. And so there's this massive disconnect when people go to think about like, what assets do I need? And it's, you cannot compare a savings vehicle to an investment vehicle. And furthermore, from a financial structure perspective, I'm a big believer, and I did the Life 180 Pyramid Talk, and if you haven't watched that, you should go watch it. It talks about the importance of how you structure your life financially, the importance of saving before you actually invest. It's like, I mean, there's a million reasons that would be probably a 30-minute conversation on its own. But the bottom line is, go watch that video if you want. I'll link it above. But the idea that you need to save, and I'm a big believer. I have the amount. I don't want to go down that route right now, but there's a number everybody should have in savings before they go take risk on, because we're told that we should invest and take that risk because the younger you are, the more risk you can take, right? Like, I mean, how many times have you heard that in your life?
Yeah.
And I believe that the younger you are, the less risk you have to take, because you have compounding on your side. And we all believe compounding is a powerful, vehicle, right? It's a powerful tool. It's something we all want to leverage and take advantage of. But the problem is, the number one thing that interrupts compounding is losses. Losses in investment accounts. And, if you have $100 and you lose 50%, you go to $50, you need to earn 100% just to get back from your 50% loss. And that's an extreme example, but that principle holds true. You know, the average rate of return, people say, you know, over the last, since 1925 in the S&P 500 in the United States is 8.3%. That's the average rate of return. So they say, listen, it's going to be up, it's going to be down, the market will perform, but if you buy and hold, it'll average 8.3, blah, 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 blah. Good for you. And the reality is, just because an average rate of return is 8.3 doesn't mean that that's what your account is going to perform at, because average rate of return is not the actualized or the real rate of return on an annualized basis. I could break it down. And when you bring losses into the equation and how your actual account value performs, it's more like 6.2%. That may not sound horrible and it's not necessarily bad, but then you back out management fees and all these things out of it. Taxes, if it's in a taxable account, you're looking at like 4.5%, 4%, you know, is what your real return after everything in the account is said and done. And that, when it comes to a compounding effect of your account value over a 30, 40 year period of time, you take an 8.3% expectation and it performs at a real return after taxes, fees, performance at 4%, you're in a lot of trouble, you know? And so that's a big problem that I have in the country, is like in the world, I guess, you know, we're talking Canada here. I'm so used to talking in the United States, but like, you know, the big problem that I have is expectations of what people think they have to do to get where they want to go are so out of alignment with reality, right?
Yeah.
And that can be solved if we just are willing to have a long-term approach, and we're really willing to start with the end in mind, and we're willing to build a financial structure with the Life 180 pyramid. I call it the pyramid because you build a pyramid from the bottom up, right? You got to build the foundation. You don't build a house on sand, you build it on a foundation. And the foundation has to be savings, because otherwise you can build all these other investments up around. But when the financial storm comes, which in a 30, 40 year time horizon, you're going to have 3, 4 of them. Like that's just the way it is. If you don't have that foundation built right, the house is going to crumble in the storm. And if it crumbles once or twice on you in a 40-year period, the level of difficulty for you to achieve your objectives is amplified.
Yeah, absolutely. And I think like one of the things I wanted to add to the discussion of rate of return versus real rate of return is the rate of return that people actually get. And so like there's a lot of studies out there that show like even if you could get, even if that 8% is true, the average investor underperform, even if someone picks a fund, right? And let's say the fund does 6. The average investor in that fund is only going to do 4.5 because the average investor panics, the average investor cashes out, the average investor doesn't keep putting money away. So there's also that, which is a big part of what I help people with, is like managing that, is the behavioral side of things. So there's that where it's like not only all those things that you listed that can impact a return, the behavior of the individual can impact the return. And then the next thing is around the pyramid. It's funny because the analogy I use is a tree and roots. I think we've talked about my tree and roots before. I'm not sure. So so the tree, I've seen a lot of people's trees fall over because all they're doing is taking risk and looking for growth, and they haven't put down those roots. And in my world, the roots are partially the protection against the loss of income, the side that I'm a very big believer in, which is protecting against loss of income due to illness or injury or death, but also that root exactly of like a savings plan, like that there is a place to go when things go like either an emergency or an opportunity, right? Like things go wrong, you need the money, things go wrong because you need the money to take advantage of a time when maybe it's the best time to have some money in the market to do something, or some money to take advantage of an opportunity. So, so I love it all. I think what we could do is maybe put up and we'll just do this as always, like spur of the moment, seat of our pants, put it side by side so that people can really see, what is it that we're talking about. So, and this has come from a conversation, like I said, where someone will come to the table, usually like, it's not always an accountant, but someone will come and they'll say, look, I don't think you should consider doing whole life because you can do better with an investment. And I think we can talk about how what they're looking at is not an apples to apples comparison. So I think we can maybe do this where it's like investment, and we can talk about pure investment. Like, and I don't care if it's a mutual fund, an ETF, a stock, an investment where you're putting money in the market and it is what it is. Like it goes up and down with the value of the company or the fund versus the whole life side of things. I'm trying to make it look like a W here. So, and this is pretty common. Like,
well, I would argue, Galen, it's not even whole life. It's like, I think whole life just falls into a category. It's a savings vehicle, right? It's like, what's an investment and what's a savings vehicle? Because I think most people understand, a savings vehicle is just a safe, guaranteed, liquid place that we need to keep our money. And that is the foundation of life. Because, when you talk about buyer behavior, like you were talking about before, how you have your life structured financially, having that savings vehicle, having that financial foundation allows you to have better behavior.
Yep, absolutely.
Right. Because you never have to make dangerous decisions or
Yeah.
poor, desperate decisions.
Yeah,
right.
Absolutely. Oh, for sure. Like the things that, if someone doesn't have a good plan in place and they're focused on just the investment side of things, when things tank or if things tank right before retirement, that's a real common one. Like I work with young doctors and they say to me, I don't know how many doctors, because a lot of them right now, it's pretty interesting. In 08, 09 is when these people I'm working with were starting to become aware of what investing meant. And they're like, oh yeah, I've met doctors who said, oh, I couldn't retire because I'd lost so much of my investments. Like the value of my investments had dropped so much that I couldn't retire anymore. So I talked to my clients about how that doesn't have to be the case. Like if you protect yourself ahead of time, that doesn't have to be a concern. And it's a common one though that I hear from young people. It's like, oh yeah, I kind of remember 08, 09. I knew I had some older mentors that were about to retire and then couldn't because the market tanked, which for me is just bad planning. Like that's not necessarily something that has to happen at all.
Sure.
Yeah,
I agree.
For sure. So yeah, sure. So investment versus saving vehicle, where do we start? I think we could start on the savings vehicle side. So what are we looking at here? Like we're looking at, there's a certain level of guarantees, right?
Yeah. Guarantees. But the guarantees I would say are there where an investment has no guarantees.
Right.
And
let's put nope here.
Nope. And so let's, an investment, has a lot of upside, right? So people invest because, I'd almost say people invest because there's this marketed FOMO, the fear of missing out. I need returns. I need to keep up with the Joneses. I need, I need my neighbor down the street to not be able to have a conversation with me, or my coworkers to have a conversation with me at the water cooler, telling me that they're earning 20% this year and I'm earning nothing. I got to keep up with the Joneses. And so, the upside potential, I think is there. Whereas a savings vehicle, I would say, the answer is not really, minimally.
Yeah. So high upside potential. And I love the water cooler example because I talk about that all the time. Because even the buddies at the water cooler are never going to talk about how much money they lost. They're all going to talk about the good days. Low upside potential.
Yeah, I would say low. I would say that the upside potential is, it depends on the vehicle, right? But there's low upside potential, right?
Yeah, let's say upside. We're really talking about growth here. Like if you said growth to growth, I feel like that's sort of maybe a more specific thing. But low upside growth. Like if you're looking at pure growth, because it's easy for people to say, this is exactly the conversation I was having recently where someone was shooting it down because they're like, oh, you could take that same money that you were going to put into a savings vehicle and we're going to put it into the market and you're going to get 6%. And, they did the math of okay, this is how much the 6% investment is going to beat the savings vehicle at 10 years, 20 years, 30 years, et cetera. And, I said, this is not a fair comparison because this is not apples to apples.
You got to talk about the tax consequences. You got to look at everything apples and look at all the numbers side by side.
So this is a good spot to put tax. There is no inherent tax preference to investing really, in the sense of, if you go out and buy a investment and it's a non-registered investment, then inherently there are minimal tax preferences to doing that.
Yeah. And I'm only dialed in on this between what I've talked with you and Cole about as far as the tax preference on the qualified accounts in the accounts that you have up there, like your qualified accounts, like our IRAs and 401k equivalents, RESPs and stuff like that. And I would say this is, at least in the United States, the biggest concern is even Joe Biden right now in his tax proposal, he wants to change the way that your tax credits work. They have the ability to tax away your wealth for you. I did a video a couple of weeks ago. The United States is $28 trillion in debt. And ironically, there's about $26 trillion in qualified accounts.
Right.
Are they going to take it all? No. Likely, obviously not. But, if we have a need to increase the tax base, you know, they could just say, listen, we're 401ks now, when you take them out, are going to be taxed at a higher percent, you know, than earned income or anything. You're in business with the government when you put your money there. And I don't know about you, but I think there, you know, the worldwide concern right now is we're printing money as a not just the United States, but the world is just dumping money into the fiat currency systems. Inflation is a concern, taxes are a concern, liability, unfunded liabilities, debt, the value of the dollars all over the place. It's all a concern for everybody, probably more of a concern in the US than anywhere else, because, you know, we're the world's reserve currency. And, you know, if we have a problem, we're going to drag all you fools following us with us, you know, down to the bottom of the ocean. But like, you know, it is what it is. You know,
and I mean, and to talk about qualified accounts, like even without speculating or imagining what could happen, I've done videos with you where I've talked about the fact that the most popular place to save money in Canada is the RRSP, and a lot of people lose half of it when they die. And maybe some people don't care about that, but most people are shocked when I tell them that, because they've only been told about the tax refund. They've only been told about, like, you know, tax deferred growth. They haven't been told that, it is tax deferred, but if someone passes away with a really big RSP and they don't have a spouse to just hand it over, a lot of people are going to lose half. And when you factor that into the rate of return, potential rate of return, that certainly takes a big hit, because it's like at any given time, you could lose half of what's in there, even if the markets are good, because it's just taxes. So I think that's the tax conversation in Canada. Like even where we're sitting right now, whatever happens in the future, where we're sitting right now, it's a big concern for people. Like I am consistently helping retirees look at the tax consequences of the great savings they've been doing all these decades. Fantastic. But it's like, did you want to leave any of that to your kids or grandkids or church or charity? Like, let's figure out how to do that. So savings vehicle, you know, is like, it's, I mean, like it's massive. It's tax deferred growth. It's tax-free payout on death. I mean, like I could go on and on. So it's like, it's
I mean, if you're talking about the whole life side of it, absolutely. You know, I think it's interesting because like you get into the, like if we were to jump ahead just a little bit and look at like saying, okay, we have investments versus savings vehicles. And so, and you were to talk to people and just say, okay, let's just agree that you buy into the concept that you don't need to invest for your future. You need to save for your future. And then doing so, you should do so systematically and kind of like the pyramid, kind of like the tree. How do you have to build? You have to make sure the roots are solid. You have to make sure the foundation is solid. And so that is saving before investing. Once you have your saving in place and you focus on the right side of this T-chart and you have that in place, that gives you the opportunity to go and invest like a real investor. Listen, I got news for you. If you're just putting money into stocks and, you know, taking risk, buying companies and mutual funds and all that stuff, and you don't focus on saving first and having that foundation built, you're just speculating, and you're going to be forced, no matter how good it feels like you're doing, even if it feels like you're doing for a 10-year period, you're just lying to yourself. And you're going to end up in a situation where you have to make poor decisions because you don't have any savings. And that's the reality. And then you're going to have to liquidate a negatively performing asset, and that amplifies the problem. That's why, you know, when we talk about saving, now it comes into a conversation of saying, okay, what savings vehicle do I want to use to facilitate this? Because we live in this world, like back in the 80s, you could put your money into a savings account and get 6%, 8%. You know what I mean? And you could go dump your money into a savings account, have a checking account, savings account, money market account, 8 to 10%, you know, and it would be awesome. Now, like, I mean, think about that. It's just a different world. Right. And so, you know, at this point in time, people are going, wow. I mean, I talked to a guy the other day, I had $1.25 million, and he's like sitting in a bank account, and he's freaking out because inflation just hit 4.2% in the United States. And he's like, I'm losing 40 grand a year. You know, just to inflation, the purchasing power of my money is getting annihilated, right? So, you know, you think about like what are the options when it comes to safe vehicles where the money is guaranteed, where you cannot lose it? Well, you have bonds. Bonds are horrible. It locks you up. You know, your money is tied up. You can't access it longer term. And plus, if we live in this low interest rate environment, in an increasing rate environment, bonds get worse and worse and worse. The value of the bond that you buy, it gets worse and worse, especially if you get into bond funds or anything of that nature. Don't do that right now. They're just horrible. So that's first and foremost. You can go into CDs. Once again, maybe, what the best you're going to get is 2%, which isn't even meeting inflation in the United States right now. But that's the best case you're going to do. And you're looking at your money's still tied up. Savings account, you're not beating inflation, it is what it is. But at least you have liquidity of the money, right? So you take it and you're nimble or whatever. And this is where people, I think, are missing the ball. And whole life insurance is actually an amazing opportunity for people to look at it as the safe, liquid, guaranteed account that, yes, there's a price of doing business because it's inside of a life insurance contract. But when you structure it properly, you can actually have a lot of liquidity, way more liquidity than people realize.
Right.
People like Galen who are licensed, who are going to sell it to you. I'm not licensed. I can't sell it, but people like Galen who would sell it to you have to take a massive pay cut to be able to do it the right way for you. And that's just a reality. And that's why people, I think, don't know about it for the most part. But the bottom line is you can have the liquidity, you can have the use of the money, you can have the control of your money. I think that's the biggest thing people are looking for in a safe vehicle is control of that money. And unfortunately, when you lock your money up in a bond or a CD or a product of that nature, you're giving up control of that money. And that savings account, that safe vehicle needs to be the vehicle that you have kind of earmarked for like really, really good opportunities or for protection, for emergency, for, downside. And when you do that, I call it a volatility buffer, right? It's you never want to have to liquidate a negatively performing asset. You never want to have to take income out of it. You never want to have to sell stocks or 401ks or RRSPs or anything of that nature. Even if you have the opportunity to, when the market is performing in a bad way. But unfortunately, that's when most people have to do it because, when you're working and things are good and whatnot, you don't have to tap into it. But it's when, the economy tanks, when people lose their jobs, when unemployment rates go up, when you're trying to figure out how to pay your bills, that's when people liquidate these assets. And that's where, your returns, even though it may look like you're getting good returns and there's upside growth in those accounts, if you don't start with the savings component of it first, it's all smoke and mirrors. It's not real. It's not a realized growth or gain until you actualize it, until you, tap into it for income, until you hit a certain place in your life where you're achieving the objective. And so starting to invest for retirement too soon is actually dangerous. You need to save for retirement first, build the foundation, build the roots of the tree, then you can start to invest for retirement on top of that. And that's going to allow you to do so like a real investor, honestly.
Yeah. I mean, I think, and I like what you're saying. It's definitely, you're laying it all out. Like you've got different ways of saving, but like you said, like the bonds, the savings account, like the traditional savings account, all these things are pegged very closely to low interest rates. Some of them, like you said, like the bonds or the CDs, which up here, GICs, typically very low liquidity. You can't really get at the money when you need it. And I mean, like I always say about GICs, like in CDs, you're kind of like putting your money in a tunnel. And when you get out of the other end of the tunnel, you got less than you started with, because that loaf of bread that you could have bought with the $2.50 that you put into it, when you come out the other end, you can only buy 3/4 of that loaf of bread or not. You have to take out a couple slices because you didn't keep up with inflation, right? And as an aside, like those safer investments tend to be the most heavily taxed. Interest income in Canada is taxed as income. So every dollar you make on a GIC is going to get taxed, unless it's inside of a special tax preferred account, you're going to get taxed on the growth, like right off the bat. Like the dollar you made goes right on the income. If you're at a 50% tax bracket in Canada, which isn't hard to hit, 40% is very easy to hit. You're losing 40 to 50 cents of that thing that wasn't even keeping up with inflation in the first place. So like when I see, and business owners who keep GICs inside of their corporations, like it drives me a little bit batty, because it's like, you're getting low growth and you're giving half of the growth back right off the bat. So I think what I really took away from that is like the foundational side. Like this is foundational. This is stable. Right. And on this side, I'm seeing it's more like it's next level. So it's like first of all, it's volatile. Like there's no volatile, and it's speculative, right? So you're saying like, and I love what you're saying about the savings and the investing. It's like a lot of people are like, I mean, really, I'm sure there's stats out there. I haven't looked at them in a little bit of how many people have to access, like in Canada, the RRSPs, how many people have to cash them out in tough times, because when they put it in, things were okay. But then later on, they're like, oh, crud, I need some of that money back.
I have statistics on that for the United States. For the last time last stats I was able to find was 2014.
Okay.
And in 2014, Americans paid $21 billion in taxes and penalty to access their 401k and qualified accounts early.
Right.
$21 billion just in taxes and penalties.
Just in taxes and penalties. Yeah.
Early.
Yeah. Like, I mean, I'd love to, I'll have to look it up for Canada. Like I've definitely seen it. It's been a little bit since I've looked at it, but it was a high percentage of people that had to, access their RSPs in an unexpected situation.
Well, 2014 was a healthy year.
2014 is a good year.
Yeah. I mean, so what's it
it's not 08, 09.
Right. What's it going to be in a down year? That's why,
like it's 08, 09, middle of 2020, like what were people doing? And then over here, like, I mean, there's inherent tax advantages. So I'll put that there, like tax advantages.
There's tax advantages. I would just add, since we have savings vehicle, tax advantages in whole life.
Yeah.
If you do it in a whole life policy, because there's not tax advantages.
No, not inside of a
bonds or, CDs or.
Yeah, absolutely.
I see.
Yeah, and in fact, it's the opposite. Like it's the exact, in Canada, it's the exact opposite. So like interest income is the most heavily taxed. Capital gains is the least, and then like dividends, like you got these different like capital gains, dividends, interest is the most heavily taxed, because you're not making like part of the tax code is part of it when it comes to the investing side of things. It does reward people for taking more volatility, because you pay less taxes when you take more volatility, but it's a whole different ballgame when you're looking at the whole life side of the savings vehicle.
So this is just another one of those scenarios where people in Canada, I mean, first of all, I'm a big believer everybody in the United States needs to take a look at a properly structured whole life insurance policy as the foundational, like what we call it as a tier one asset. I've got this, I don't know if you've ever read it, dude. There's this book. It's amazing. I haven't told you the story yet. So Pirates of Manhattan. Have you seen it?
I have it. I haven't read it yet, but I have it in my,
you got it
on my shelf.
It talks about whole life insurance as a tier one asset for corporations and banks and what it can do. And when you realize why it's considered a tier one asset, you're like, holy crap, where can I get some of that? You know what I mean? Like it really changes everything. And so I did a video on this last week, and the author actually called me. It was crazy, right? So we ended up having this conversation, and now Barry Dyke, the author of this book, and I are going to be doing a monthly podcast or a monthly video series on this channel.
Cool.
How sick
Very
is
cool.
that? And so
I'll have to get in touch with them, because when I bought the book, I had to pay like an extra $25 in like import taxes. So I'll have to get them on the horn. No, I was kidding.
Good old Canada, I tell you.
Yeah, well, I got the book, and then like months later, FedEx sent me like a bill, and I was like, "What is this bill?" I was like, when you send stuff to Canada, it's crazy. Like if you don't categorize it the right way, you have to pay these extra import fees and stuff. But no, I have the book. I an advisor that that's like really one of my unofficial mentors in the business. He spoke live to a group of us last year, and he's like, you got to pick up this book. So I'll have to check it out.
Yeah, it's really awesome. I mean, he just sent me another book. He's got a new book he wrote, Guaranteed Income, and he's got Guaranteed Income 2.0 coming out later this year.
Cool.
So he actually just sent me a copy of his latest book, because I have his first two and they're amazing. And so I would just say, check that out, because when you realize the why behind that, and I would say those books are more for advisors, engineer mindset people that really want to get their head around the statistics and like all the moving functional parts behind whole life. And if you really want to get into the why, it's definitely, it's very granular. And it's pretty, I love that kind of stuff.
Yeah. I got one of those on my shelf. I'll have to I won't grab it right now, but it's called The Retirement Myth. And that one is like crazy formulas and stuff. And I'm like, even a lot of advisors, like I picked it up years ago, same guy recommended I read it. And it's all about, how to guarantee your income in different vehicles that most people don't look to for guaranteeing. And it's pretty numbers heavy, but pretty fascinating. But
totally. And so, so depending on what stage of life you're in, I mean, that's where insurance companies are the companies that can get you those guarantees that banks get you, but better, because this is why I love insurance companies for a savings vehicle. A lot of people in the United States go, well, they're not FDIC insured. Well, it's like, wow, they have an insurance guarantee company that handles it all. Agents are not allowed to talk about it, which is weird because it exists, but they're not allowed to talk about it to influence people's decisions to buy. It's kind of strange. However, the reason I don't even care and the reason I'm not worried about it is because guess what? Back in the Great Depression, back in 2008, situations like that, when all these banks went out of business and became defunct, not one whole life insurance mutually based company had to be bailed out. Not one, either kind. Why? Because these companies don't participate in the fractional reserve banking system. They're not leveraging. They're like, there are no financial institutions in the world that are better at managing money and getting guaranteed growth and managing a long-term view. And so when it comes from that perspective, if I'm going to work on figuring out how do I guarantee a result in my financial life, I want to work with and entrust insurance companies with managing my money. Because, it's funny, when I was talking to Barry Dyke on the phone, he said in his new book that's coming out, he actually found proof, like documented stuff in their books, because they're a publicly traded company, right? So it's all public proof that they make about, I might get this a little off, but I'll be really close. 70% of their revenue comes from revenue generated by investing for people, right? Managing people's money. But when it comes to their personal pension for their executives, for their higher up employees, not one penny of their pension funds are invested in the markets. They're all in permanent whole life insurance and annuities with insurance companies. 100% of it. 0%.
That says a lot.
I mean, and this is the company that you're paying to manage your money. Like it's insanity to me. Like the level of hypocrisy in what people are doing, is, versus teaching and preaching as far as like corporate levels down to Main Street America and Canada is, I know you guys got Bay Street, right? Like that's your Wall Street.
Bay Street,
so,
yeah.
it is what it is. So like, it's crazy, man. But I would say the takeaway from this video, even though we went on a couple little rants, the takeaway is save first, figure out what you have to save. I'm a big believer that it should be 2 years of income. That's just my belief. If you don't, go watch my Life 180 Pyramid video, you'll understand why. But I'm a big believer you need 2 years of safe, liquid, accessible money, because 1 year for opportunities, 1 year for emergencies, period. That just protects you. You can make really solid financial decisions at that point in time. Once you have that, now you can actually invest like an investor. You can take risks. You can have the upside potential. You can chase that growth. And then when the market does have a downswing, which it's going to, you don't have to make bad decisions around that pool of money. You can just tap in and use your whole life policy savings vehicle as a volatility buffer. So you can use that to survive. You can use it to find opportunities in down markets, and it can make everything better. So for sure, that's powerful. If people understood and just implemented in that way, I mean, I'm telling you, the world would be a different place.
Absolutely. Yeah, for sure.
Anyway, man. Anything else?
No, I think it's great way we've broken it down. And I mean, yeah, once you start peering behind the curtain is the way all these things work.
Yeah.
And like where people are putting their money and how they're using it. It's definitely it's eye-opening as to how these things can make a ton of sense for people.
Rock and roll, man. Well, cool guys. If you haven't already, I would really love it and appreciate a like on this. If you found value in it, YouTube, the more likes and engagement the video gets, the more YouTube just gets it out there to people. So obviously, the more likes are appreciated because it shares our mission and message with the rest of the world on a bigger, more impactful basis. And if you haven't already, go ahead and hit the subscribe button. Make sure you click the bell. That way you get notified every single time we launch a new video. But until next time, have a blessed, inspirational day. We'll talk to you soon. Thanks, Galen.
See you.
Later, man.